Well, you're watching Market Guru, and now joining us is Jyoti Vaswani, the CIO at Future Generali India Life Insurance. Ms. Vaswani, welcome to the show.
Thank you.
It has been a very interesting time for the markets right now because we are looking Nifty at 11,000 plus levels. A lot of thoughts around. There are 2 points, or I should say there are two sides of the coin here. On one side, again, there has been a very strong run up in the markets. Everybody again is waiting for that sort of material correction here. Like some investors, they would be worried, or they would be actually slightly afraid that perhaps can the correction be actually very deep. On the other side, actually, you're talking about abundant liquidity, very buoyant global markets, 14 months on the trot, new record highs on MSCI index, the global index, and that tells you that the mood across the world actually is very buoyant here. So what I want to ask you for our viewers is that, is there any sort of risk on the horizon which are looking at the markets, or you think that actually things have just started to turn around the corner with the economic parameters now actually showing some green shoots here?
So I think India has been part of a global rally. So it's not in that India is rallying in isolation. So India is part of a global rally, and the global rally is emanating from two factors. One is that the growth in across the globe has been buoyant. You saw US growing well. You saw a recovery in Europe. You're seeing recovery in Japan. So there is a all-around growth which is looking good.
And one by one everything.
And one by one everything has picked up. And plus you had liquidity. So last year you had highest liquidity injection by the the banks, the ECB and the Bank of Japan last year, and that's nearly $1.8 trillion. So it's been a combination of liquidity and global growth which has actually resulted in this kind of a rally across the globe. Coming to India, I think we had the best parameters, economic parameters last year. Nifty has given a return of around 13 or 14% CAGR over the last 5 years, and our earnings growth has been just around 3 or 4%.
Right.
So clearly the markets have gone up in anticipation of an earnings recovery. So if you look at last year, I think we had the best economic parameters. We had the lowest current account deficit, the low fiscal deficit. We had crude, which was biggest, we benefited the most from the crude prices, which were the lowest. We had, everything, the lowest inflation. We had low interest rates. We had everything that you could talk of, which was, the best economic parameters last year. And the only thing that was missing was corporate earnings.
Right.
And there were various reasons for that. The recovery was postponed because of structural reforms like GST and demonetization, but nevertheless the earnings have always been downgraded last year. So I think the only
in fact,
piece
for the last 3 or 4 years, almost from the start to the end of the year.
Absolutely. So it's been so the corporate earnings piece was missing, and therefore the PE multiples look slightly on the higher side, because today we are talking of a 20 times trading multiple. This year, if you come to this year, I think three things which will change is the economic parameters are no longer the best. We have an inflation at 5%. You're seeing interest rates moving up. You're seeing crude at 70.
Yeah.
And so therefore that will reflect in your fiscal deficit and your current account deficit.
Petrol might be a totally different orbit.
Absolutely. So everything else is now not looking as good as it was last year, but corporate earnings are going to start looking good. Right? This year, the second half of FY18 is going to look good because of last year's base effect, of course. But next year, we expect a 15 to 18% growth in corporate earnings.
Right.
So the corporate earnings story is just beginning to play out. And with the budget, let's see how the budget pans out. But if the monsoons are good, the story is going to look good. The GDP growth, which was which fell in the last 2 quarters, is likely to come back to 7% plus in the next year. So clearly, that's going to reflect the banking system is getting better. The balance sheets are getting better. So clearly the private capex will pick up shortly. So it may be another couple of quarters before the private capex steps in. So therefore you will see that growth now coming in. As far as liquidity is concerned, this year in the international markets, the liquidity is going to be much lower from last year. So that's going to have some impact on,
So what sort of risk do you see from that? Because if there is a withdrawal of liquidity, do you believe that emerging markets actually can see some sort of correction from where actually they are trading right now? And again, I'm just going back to that sort of classic theory. You trade on a relative basis. If actually you are a foreign institution investor, you think that, okay, this time India has run up, then you go to actually Philippines, then you go to Malaysia, then you go to Brazil, and then you come back to India. That's sort of classical round trading here. So if there is a withdrawal of money here, do you believe that there could be a derating of emerging markets?
So if you look at it last year, FIs did not invest much in India. Okay, we had just $8 billion of inflow, and they invested much more in the other countries because the earnings did not keep up pace in India, and therefore that's one of the reasons. So what helped India in the Indian markets rise was the domestic liquidity, which was unprecedented. We saw the highest amount of domestic liquidity last year, right? So that was an unprecedented domestic liquidity. But this year, because the corporate earnings are going to come in place, the GDP is going to start looking better.
The money to return.
The FII money should start coming in. Right, so maybe they would be shifting. So last year they shifted out of India to other markets. This year it could be the other way around. Money could come into India instead of, because the economic parameters. Now we're going to talk of the highest GDP growth numbers this year again. So last year we had taken a step back on that, but this year we're going to come back with that kind of a strong GDP growth number. So clearly the FIIs will start putting in money in India this year. That's what my reading would be. And domestic liquidity would continue because as we talked about, there hardly any alternate investment avenues available. So while the interest rates have started to inch up, but I think equity as an asset class has the power of compounding and gives you the maximum returns, right? So clearly money will continue, and I think large money is coming through SIPs and mutual funds, which hopefully should continue.
It's a sustainable source of money.
It's a sustainable source of money. So clearly, unless there is a massive global correction, India may not correct to significantly because there is a lot of money waiting in the wings to come into India, and this now includes FII money as well as domestic money.
In a course of correction, because I'm just trying to think about a scenario again, even if the correction happens, what do you think, which sectors I think could actually sustain or basically provide that sort of valuation opportunity here? I'm just asking you some themes here, maybe like you can actually say about some other themes if you want. Insurance, IT, pharma. Pharma has been relatively underperformer, maybe trading in the range of 10-15%, but it's like has been a value buy, but I think has remained a value buy for the last 2 or 3 years. IT again, significant re-rating in the last 1 month. Insurance as a space, I've seen the stocks, very handful of stocks, but still a lot of money is going into those stocks here. Apart from that, again, banks, again, they have not done actually much. If I leave HDFC Bank, if I leave again HDFC, if I leave Yes Bank, but again, if I look at ICICI Bank or Axis Bank, so there are a lot of banks again who are still trading, which are still trading again at the prices which are we may be seeing, we actually were seeing 15 months back. So do you believe like these are the sectors perhaps they could perform, or there is a risk prevalent across the board here?
So I think I would be very bullish on the banking sector. While you did mention that, so while last year everybody was talking of private sector banks and, that was a story, but I think this year it's going to be the public sector banks which will probably perform much better. A lot of things have worked in favor of public sector banks.
Do you believe they could be outperforming the private banks?
I would think so, yes. Okay. Because I think a lot of, the problems that they had last year in terms of NPAs that should get resolved, the NCLT thing is really helping. The recap bonds will help them. The excess liquidity is out of the system, and now
some provision reversals.
So the provision reversals are happening and will continue to happen. So I think they'll get more aggressive. So till last year, the NPA problem was pulling them down. The credit offtake was not picking up. Now you're already seeing a double-digit credit offtake number. Right, so and that I think will give the confidence to the PSU banks to get a little more aggressive. They were probably not as aggressive last year because of the NPA issues. So I think that credit offtake, if you're playing the credit offtake theme in India, I think it's going to be the PSU banks which are going to be the largest beneficiary this year.
But will that be retail focused or corporate banks? Like, will that be, I know you won't be talking about stocks, but I'm giving examples. Will that be SBI, Bank of Baroda or PNB, or you think that there could be some specific niche theme within the PSU banks that should be playing out?
I think it will be a combination of both. I think so, not to take away the fact that retail would continue to grow, but the pace at which retail has grown in some of the private sector banks, there could be some pockets of worry which would emerge going forward. But I think it's going to be, for PSU banks, it's going to be both retail and corporate play. That's what I would think. So we are quite bullish on the PSU space this year.
Just to ask more, because it's very interesting here, is that you have on one side private banks here. The names could be Yes Bank, IndusInd Bank, Kotak, ICICI, HDFC, all those. But then again, on the other side, we just talked about PSU banks here. On the third side, you have a lot of NBFCs again. Very good price appreciation in terms of stock price returns. We have been seeing they've been gaining market share. Take the names of Bajaj Finance, L&T Finance, again, sudden turnaround because they're trying to focus there actually in terms of less segments here. And the other, M&M Financial again, basically in terms of rural sort of theme, where actually is being played out. So what's your own perception right now between the NBFCs, could be even the gold financing companies, I just didn't take the names. So between these three, what's your own perception? Because you said that PSU banks might be outperforming the private banks here, but what about NBFCs?
So NBFCs had a very good year last year. One of the reasons also was that PSU banks were not so aggressive, and therefore, so the credit offtake in the banking system looks at around 5%, but the actual credit offtake was much higher at 9% if you include the NBFCs and the bond issuances, etc., etc. So the credit offtake growth last year was closer to a double-digit number. Now this year, we do expect that the NBFC sector will face some challenges. First, there will be more aggressive competition from the banking space.
Right.
Second, the cost of funds is moving up for the NBFC sector, and therefore repricing, they'll have to kind of pass on, which benefit will be available with the PSU banks for some more time, because they're sitting on excess SLRs and their CD ratios are much lower, so they have liquidity and they don't need to raise their cost of funds immediately. So that will give them some kind of benefit. So therefore, that's the aggressiveness perhaps which the banks would show would be something which would impact the NBFC space to a certain extent. But that would be more on the margin front, and I think more or less, the consumption theme is a theme which we are talking of the next year as well, and therefore clearly NBFCs will also stand to gain a part of that pie, right? So it's not that they would not grow, but probably there will be some kind of impact on the margins.
Right, and my last question to you would be that we talked about the financials here, where again you actually are talking about that there is a revival right there. We are looking at the budget, so what would be your expectations from the budget, from the theme perspective, or from like what actually could be bringing out for the markets here? And secondly, basically linking to the budget also, but also what about the consumption theme here? Because on one side the stocks are very expensive, but on the other side actually we might be thinking that yes, this year could be different from the last year. Now last year we had disruptions. This year again the revival of growth, or perhaps consumption could also start increasing here. So what's the opportunity from budget point of view, your expectations, and how is the consumption looking to you?
So the budget, I think while there's a lot of talk that there will be a lot of populist measures in the budget, I think the government would not want to, kind of shake its reformist image. So I think it would be more, they'll be able to balance populism and reforms in a good way. I think the first sign is also about, if you saw the government borrowing program of last year, which they actually hiked by 50,000 crores in December, but they've already brought it down to 20, they reduced that. So clearly they are focusing on fiscal, they don't want to give up on the glide path on fiscal path, so they don't want to do that. So clearly, while they'll have to go for popular measures because of the, there are a lot of elections coming up, state elections, this year itself, state elections, plus you have the general elections next year, and what happened in Gujarat is probably a reality check for them as well, that they need to do something for the farming community, they need to do more for the poor, and therefore that would definitely come in the budget. But at the same time, the focus has been on investment. So last year, if you see, they were struggling with the fiscal deficit number, yet they did not cut back on capex. And I think that's something which is credible, because most of the time fiscal deficit is the number is kind of maintained, but cutting down on expenditure, which did not happen. So clearly they know that they have to revive the economy, and private capex is still not there, so therefore government capex cannot stop, and therefore that would continue next year's budget as well. So I think the theme would be on investment this year's budget as well, and the consumption story would play out, because if the focus is so much on reviving the rural economy, which was actually pulling down consumption last year, it was only the urban consumption which was working last year. So therefore that will also start to play out this year. So you'll have both the rural and the urban consumption story playing out this year, and therefore that theme would continue in my view.
Then I think I should ask you, which are the sectors again which you would like to be overweight for this calendar year, and also the sectors where you think that perhaps some underperformance could be seen. So overweight sectors and underweight sectors from your perspective.
So as I said, the corporate earnings growth last year was not there, in this year it's expected to reflect. So it's expected to reflect in the consumption theme and also in the investment theme. So therefore I think I would rather go with sectors, I'll talk more about sectors which I'm a little, conservative on, or probably neutral on, and one of them would be real estate. So while we have seen the impact of formalization of the economy and RERA on the, the real estate market last year, this year we are watching it. There are some early signs of revival, but we are still not sure how the sector is picking up. So we are watching it very closely, and at the moment we are keeping an underweight stance on that sector. The other sector is telecom. While we do think that perhaps it could be out of the woods right now, the consolidation phase is on, and when generally a consolidation phase is on in the markets, it's a sign that the worst could be behind us. But having said that, there is still 3 large players going to be there, and we're going to be fighting for market share, and we need to see how long that continues. So we are watching that space as well, though we think that, we are seeing early signs of recovery in that sector. So that's another sector. On the pharma side, we have seen structural issues last year. We had a whole host of problems in US, which these our Indian companies were not used to. There was a pricing pressure, there was a consolidation of our customers, we had the regulatory challenges and whole host of things which kind of affected the Indian pharma companies. Coupled with that, you had even the domestic issues like the government talking about generic, etc. So the domestic business, which was a cash cow, was also getting impacted because of that, as well as the GST impact which came in. But therefore, I think that segment is now evolving. They're spending more on R&D, focusing more on specialty products and changing their business models. And that will start to reflect now. So I think the valuations are very cheap on the pharma side, and so we are having an equal weight on pharma sector, but we have not yet gone overweight because we are still watching the situation as to how things would pan out. But I think rest of the economy, all the sectors, right from auto to cement to banking, as I said, it's a play on the recovery of economy, and therefore we are quite bullish on those sectors.
Right, again, so thanks a lot for all the insights, and that's the word coming from Jyoti Vaswani. In terms of sectorals, again, consumption, investment, those are the 2 themes which would be standing out for 2018. Sectors again, where again she's underweight right now, or she's actually watching with good sort of caution right now, would be realty, telecom and pharma again. So, but we're looking towards the budget here. So perhaps a lot of announcements. So again, consumption, investment and financial we just talked about. Again, those are the areas where again one should be focusing on. With that, it's a wrap on this edition of Market Guru. From the entire team here, thanks a lot for watching us.